Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive into the mechanics of the market.
It is great to be back. We have quite the stack of research to get through today.
We certainly do. Today, we are turning our attention to the hardware layer of the AI stack. We've spent a lot of time discussing the brains of the operation, the GPUs, the Nvidia chips, the software models.
Oh, the glamour stuff.
Exactly. But today we are looking at the nervous system. The nervous system that allows these massive AI clusters to actually talk to one another. We are breaking down Lumentum Holdings, ticker symbol LEE.
Lumentum is one of those companies that sits right at the intersection of a massive technological supercycle and some very, very brutal economic realities. It's a fascinating case study.
It really is. And looking at the chart, it's been a wild ride. The stock has rallied roughly 450% recently.
Just an incredible run.
It feels like the market has anointed this company as the next critical winner in the AI boom. But the central question we need to answer today, and this is what we're going to spend the next hour unpacking, is whether that price movement is grounded in durable fundamentals or if we are seeing a textbook example of a reflexivity bubble.
Right. Are we looking at a company that has fundamentally changed its economic destiny? Or are we just seeing a temporary shortage of components that is driving a narrative the fundamentals can't actually support long term?
Exactly. Are there hidden cracks in this fortress? Because when you trade at 165 times earnings, you need perfection. We're going to find out if Lumentum is offering perfection or just a really good narrative.
That is a huge topic. But before we get into the physics and the financials, we need to cover a quick bit of housekeeping.
Right. If you're looking to invest, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments.
Now let's get into it. Pillar number 1, the business model.
Let's strip this down to the studs. In the intro, I called them the nervous system of AI. That's a nice metaphor, but let's talk engineering. What is the actual business engine here?
Right. What do they sell?
Yeah, because when I look at their product catalog, it's a dense list of optical components. We see transceivers, tunable lasers, 3D sensing modules. How should a generalist investor conceptualize what Lumentum actually does?
At its most basic level, Lumentum designs and manufactures the physical layer of the internet. We often think of the cloud as this ethereal, abstract thing.
Sure, it's just out there.
But the cloud is actually millions and millions of servers sitting in massive data centers. And for those servers to function as a single computer, which is what AI requires, they need to exchange petabytes of data instantly.
Okay.
Lumentum builds the on-ramps and off-ramps for that data.
So they're converting electrical signals, what computers use, into light signals, what travels through fiber optic cables.
Precisely. That is the core transaction. They take an electron, turn it into a photon using a laser, shoot it down a glass fiber, and then catch it on the other side and turn it back into an electron.
So it's a translation service in a way?
A very, very fast translation service. And they are primarily a B2B hardware sales organization. They aren't selling to you and me.
Not to consumers.
No, they are selling to two main groups: the hyperscalers, your Googles, Microsofts, Amazons, and the telecom OEMs, so companies like Nokia and Ciena.
Okay, so they are the arms dealer to the cloud wars. But I want to push on the economics of this. You mentioned hardware sales. Historically, hardware is a tough business. Moore's law dictates that performance goes up, but price usually comes down.
That's the deflationary trap of this entire sector. It's a key point to understand. Historically, the price per gigabit of data transmission falls.
It falls. Not stays flat, but falls.
It falls by about 10 to 15% every single year.
That sounds brutal. That means you have to increase your unit volume by 15% every year just to keep your revenue flat.
Yes.
You have to run faster just to stay in the same place.
Exactly. It is a grind. It's usually a low-margin, high-volume game.
Right.
But, and this is the key, this is why the stock is up 450%, we are currently witnessing a massive economic anomaly.
An anomaly.
Lumentum has seen a 1,700 basis point expansion in their operating margins recently.
Wait, say that again? 1,700.
1,700 basis points, yes.
That's 17%. In a hardware business, that is usually impossible unless you have a monopoly.
Or unless you have a shortage. And that is what I think the market is misinterpreting. The market looks at that 17% jump and thinks, aha, Lumentum has achieved structural pricing power. They are like Apple or Nvidia now.
But you're saying they aren't.
They absolutely aren't. This is what economists call scarcity rents. Right now, the world is desperate for high-speed transceivers.
Yeah.
Specifically, the 800 gigabit and 1.6 terabit models needed for the newest AI clusters.
Let's pause on that. Why those specific speeds? Why can't they just use the old 400G stuff they already have?
It all comes down to the architecture of these new GPU clusters. When you connect, say, 10,000 H100 GPUs together,
Which is what they're doing.
that's what they're all doing. The bottleneck isn't the calculation speed of the chip anymore, it's the network speed. It's the communication between the chips.
So the GPU is just waiting for data.
It's sitting idle. That $30,000 chip is doing nothing. So the hyperscalers are ripping out the old plumbing and installing 800G pipes as fast as they can. And Lumentum just happens to be one of the very few companies that can manufacture these specific high-speed lasers at scale.
And what's special about these lasers?
It's the material. They use indium phosphide.
Indium phosphide, that's the key here, right? It's not silicon.
Correct. Silicon is great for logic, for computation, but it's terrible at generating light. It's just a fundamental physics problem. So you need these more exotic materials like indium phosphide to create the laser beam itself.
And Lumentum is good at that.
They've mastered the process of growing these crystals and packaging them. And because there's a global shortage of this specific manufacturing capacity, Lumentum can charge a massive premium.
So it's like selling umbrellas in a hurricane. You can charge $100 for an umbrella and people will pay it because they're getting soaked.
Exactly.
But once the storm passes...
It's back to being a $10 item. Scarcity rents are, by definition, cyclical. They are not permanent. The market, I believe, is pricing this stock as if the hurricane will last forever.
That brings us to the Lollapalooza effect you noted in the research. This is a Charlie Munger term, right? When multiple forces push in the same direction.
Yes, a rare convergence. The rally wasn't just one thing. It was three distinct factors hitting at the exact same moment.
Okay, what's number one?
First, you have the AI Capex supercycle. The hyperscalers are in an arms race. They're doubling their infrastructure spend, buying anything that isn't bolted down to ensure they win the AI war.
The build it and they will come phase of a new technology.
Exactly. Second, you have the supply scarcity we just discussed. Competitors, companies like Coherent and others, stumbled. They failed to ramp up their 800G capacity quickly enough. They had yield issues, manufacturing problems.
Oh, interesting. So Lumentum won by default, in a way. The other guys dropped the ball.
To an extent, yes, which, is still a win. But credit where it's due, which brings us to the third and maybe most important factor, the CloudLITE synergy.
This was the acquisition they made recently, CloudLITE.
Yes. And looking back, it was a stroke of genius or just incredible luck.
Tell me more. What did CloudLITE do?
So Lumentum traditionally made the laser chips, the really tiny, complex components, and sold them to other companies who would then put them into the metal box, the transceiver module.
The finished product.
Right. CloudLITE was one of those module makers. By buying CloudLITE, Lumentum vertically integrated.
So instead of just selling the engine, they started selling the whole car.
Exactly. And they did it right at the moment when the demand for cars just exploded. If they hadn't bought CloudLITE, they would have just been a component supplier seeing a small bump.
A small bump.
But because they own the module assembly capacity, they captured the full value of the shortage. They got the scarcity rent on the whole system.
That explains the hockey stick graph on the earnings. I'm looking at the numbers here. They went from a loss the prior year to $1.67 EPS in Q2. That is nonlinear growth.
It is. It's explosive. But again, we have to ask, is this the new normal? Or is this just a moment in time?
Well, to answer that, we have to look at the moat. Pillar number 2. We always talk about economic moats. What protects a business from competition? If Lumentum is making so much money, surely competitors are coming for them. What is the moat here?
That is the billion-dollar question, and it's a complicated one. If you apply our synaptic framework for moat assessment, Lumentum scores very high on what we call process power.
Define process power. Is that different from just having patents and IP?
Very different. Patents are IP. I mean, anyone can read a patent. Process power is the tacit knowledge, the know-how of actually building the thing at scale.
The secret sauce.
The secret sauce. You see, yielding complex optoelectronics, getting a laser chip to work perfectly is incredibly difficult. We're talking about aligning microscopic mirrors and lenses with submicron precision. If you are off by a fraction of a human hair's width, the signal is lost.
And doing that once is hard. Doing it a million times a quarter
is excruciating. It takes years and years of engineering to get that right. Lumentum, especially post-CloudLITE, has proven they can run these manufacturing lines better than almost anyone else. They have the cookbooks for these exotic materials. That is a real moat.
So their moat is that they are really, really good at making difficult things in large quantities. That sounds robust.
It is robust
Yeah.
for now. But we have to look at the anti-moat.
The anti-moat, what's that?
Yes. In technology, your moat can be rendered irrelevant if the battlefield itself changes. And there are two massive threats on the horizon that could make Lumentum's process power completely obsolete.
Okay.
We need to talk about LDO and CPO.
Acronym alert. Let's break these down simply for everyone listening. LDO and CPO.
Let's start with CPO. That stands for co-packaged optics. This is the big one. This is the existential threat.
Existential.
Yes. Right now, Lumentum makes a pluggable transceiver. It looks kind of like a thumb drive. You walk up to the server rack and you plug it into the port. It's a separate modular device.
Right, it's a distinct component. I can hold it in my hand.
Semiconductor giants like Nvidia and Broadcom look at that and they say, why is that a separate part? It adds latency. It uses way too much power. Why can't we just build that optical functionality directly into our GPU package?
Oh, so they want to cut out the middleman entirely. They want the optics to sit right next to the logic chip on the same piece of silicon.
Exactly. They want to eliminate the copper trace that goes from the chip to the edge of the board. If they succeed with co-packaged optics, the pluggable transceiver Lumentum's core product ceases to exist.
Wow, that's not just competition, that's obsolescence. You're not fighting another transceiver maker, you're fighting the architecture of the computer itself.
And you are fighting Nvidia. When your potential competitor is a $3 trillion company that controls the entire ecosystem, that is a very scary place to be.
So Lumentum is effectively fighting a war to remain relevant in the AI stack. Their moat is narrowing.
It's narrowing, not widening. That's a great way to put it.
So if CPO becomes the standard, Lumentum loses the module revenue. Do they have anything else to sell in that world?
Well, they would still try to sell the lasers, the actual light source, to Nvidia,
Oh.
but the value capture just collapses. You go from selling a $1,000 module to selling a $50 laser.
A 95% drop in revenue per unit.
Something like that.
Yeah.
It completely changes the financial model.
That puts a serious damper on the long-term growth thesis. What about the other acronym, LDO?
LTO is linear drive optics. This is more of a half step. It's less dramatic. It's still a problem.
Okay.
It simplifies the module. It removes the DSP, the digital signal processor, from the transceiver to save power. The DSP is a complex chip that cleans up the signal.
So it makes the module dumber, in a sense.
A little bit, yes. And a dumber module is easier to make. This lowers the barrier to entry, meaning cheaper Asian competitors can make them more easily.
So CPO kills the volume and LDO kills the margin.
That's the bear case in a nutshell. You've got pressure from above and pressure from below.
What about their brand? Does Lumentum mean anything to the buyer? Is there any soft power here?
Not really. We look at the Glassdoor reviews to gauge the internal culture. It paints a picture of intense pressure, very execution-focused. They are under the gun to meet hyperscaler deadlines.
Which makes sense.
It does. But it's not a culture of, say, deep disruptive innovation. It's a culture of hitting your quarterly numbers for your very demanding customers.
And if Google says jump, a supplier has to ask how high.
Correct. And that highlights the customer concentration risk. It's huge. They are beholden to Apple for their 3D sensing business think Face ID on your iPhone and the hyperscalers for Datacom.
And Apple is notoriously tough on its suppliers.
Notorious for grinding suppliers down to the bone. They do not let suppliers keep high margins for long. It's just not in their DNA.
So no pricing power from the brand, major customer concentration risk, and the manufacturing mode is under siege by the laws of physics and Nvidia. That's a sobering picture.
It is, and that's why we need to look very, very closely at the financials in Pillar 3. Because if the qualitative story has holes, the numbers better be absolutely bulletproof.
Let's move to Pillar 3 then, financial resilience and the quality of earnings.
This is where we need to put on our forensic accounting hats.
I was looking at the non-GAAP operating margin. It hit 18 to 20% in Q2 FY26. I mean, that is a massive jump from the low single digits just a year ago. That looks like incredible operating leverage.
It looks beautiful on the PowerPoint slide deck that they show to investors. It really does.
But you're implying there's a catch.
There is a massive divergence between the non-GAAP numbers, the ones Wall Street loves to quote, and the GAAP numbers, the ones that actually follow standard accounting rules.
How big of a gap are we talking about?
The GAAP operating margin is only 9.7%.
Wait, 20% versus 9.7%. That is less than half. Where did the other half of the profit go? What are they excluding?
Primarily two things: stock-based compensation, or SBC, and amortization from acquisitions.
Ah, the classic tech trick. Paying employees with stock instead of cash, and then telling investors, hey, don't count that as an expense.
Exactly. Nearly 50% of the claimed profitability is actually SBC and these amortization adjustments. Now, the argument is that SBC is a non-cash expense. No cash leaves the bank account today,
Sure.
but it is a very real cost to shareholders.
Because it's dilution. They are printing new shares to pay the engineers. My slice of the pizza is getting smaller every single year.
Precisely. You are being diluted to pay for the growth. If you treat SBC as a real expense, which Warren Buffett argues you absolutely should, the real economic profit of this business is significantly lower than that headline number suggests.
That is a huge red flag for quality of earnings. It suggests the business isn't generating enough actual cash to pay its talent competitively without giving away a big chunk of the company.
It does. It clouds the picture. However, to be fair to the management, we have to look at capital allocation. How are they spending the cash they do generate?
The CEO's report card.
Exactly. Historically, Lumentum's return on invested capital, or ROIC, has been poor,
How poor?
less than 10%. This was largely because they had a lot of goodwill sitting on the balance sheet from past acquisitions where they perhaps overpaid.
But that's changing.
It is. With this explosion in net operating profit, after tax NOPAT in 2026, their ROIC are past finally crossing the WACC threshold. They are finally generating returns higher than their cost of capital.
That is the textbook definition of value creation. So things are improving there. And the Cloud LITE deal specifically, how do you grade that?
That gets an A grade, no question. It cost them $750 million. At the time, that was a huge check to write. It was a bet the company moved.
Fair risk, high reward.
Very high risk. If the AI boom hadn't happened, or if they'd messed up the integration, they would be in big trouble right now. But it paid off spectacularly. As we said, it's the sole reason they're catching this AI wave.
So they took a big swing and connected.
It did. Without Cloud LITE's manufacturing lines in Thailand and elsewhere, they would be sitting on the sidelines watching Coherent or InnoLight take all the money.
So smart strategic M&A, but questionable accounting on the margins. What about buybacks? Companies in this position love buying back their own stock to boost EPS.
And this is where I have a major warning for investors. We talk about the cannibal rule companies that eat their own shares to increase value per share. It can be a great thing.
But there's a condition.
You should only do that when the stock is undervalued. You buy low. Buying back stock now at 165 times earnings would be capital destruction. You are buying high.
You're just incinerating shareholder cash at that point.
Every dollar they spend on buybacks today destroys value. Because the earnings yield is so incredibly low, they should be hoarding cash or paying down debt, not buying their own expensive stock.
165 times earnings.
We need to pause on that number. That leads us perfectly into Pillar 4, growth, valuation, and the reflexivity bubble, because that number implies some truly astronomical future growth.
It implies the current shortage is not a shortage at all, but the start of a permanent new plateau. And history has a very, very different lesson for us.
Let's unpack the growth engine first. The entire bull case, the entire story, it rests almost entirely on datacom, doesn't it?
It does. The thesis is that datacom revenue, the AI transceivers, will grow at greater than 50% compound annual growth rates for several years.
And the other parts of the business, the legacy business, the stuff they sell to telecom providers like Verizon for the backbone of the internet, that's flat. It's cyclical. It's not going anywhere fast. So as an investor, you are paying for that AI growth and that AI growth alone.
Well, we've seen this movie before, haven't we? In 2000 with the dot-com crash, and again in 2018 with the last optical cycle. What always happens?
The glut happens. In hardware, shortages are always resolved. Always. Capital rushes in, competitors build new factories, and suddenly the market is flooded with supply.
And when supply meets demand.
Prices crash. It's economics 101.
So the narrative of perpetual shortage is one of the most dangerous in investing.
Extremely dangerous. Trees don't grow to the sky. But right now, the market is pricing Lumentum at 165x trailing earnings and about 50x forward earnings.
Let's put that into context for a minute. Nvidia trades at, what, 35 or 40 times forward earnings?
Somewhere in that range, yes.
And Nvidia has a near monopoly on the most important chips on the planet. Lumentum is a component supplier in a historically cyclical industry. Why is it trading at a higher multiple than the king of the hill?
That is the reflexivity bubble. This is a concept George Soros popularized. The rising price itself becomes the fundamental data point that investors rely on.
So the story follows the stock price, not the other way around.
Exactly. They see the price going up 450%, so they invent a narrative to justify it. Oh, optics are the new chips. The high stock price then allows the company to potentially raise cheap capital or make acquisitions, which fundamentally improve the company, which drives the stock even higher. It's a feedback loop.
Until the music stops.
Exactly. It creates an incredible fragility. A 50 times forward multiple implies that earnings will double again in 2027 and then probably double again in 2028. If growth slows to just 20%, which objectively is still fantastic growth,
Absolutely.
the multiple compression will be violent.
Walk me through the math of that compression. How bad could it be?
If the market decides Lumentum is a cyclical hardware company again, and not a magical AI unicorn, the multiple goes from 50x to, say, 20x. Even if earnings stay flat, the stock price drops 60%.
60%.
The place is validating the narrative, not the cash flows. And that's a dangerous game. So let's try to find the ground floor, intrinsic value triangulation. What do the models say the company is actually worth if we strip away all the hype?
We ran 3 different models to try and find a zone of reasonableness.
Okay.
First, historical mean reversion. Over the last 5 years, Lumentum has traded at an average PE of about 25x. If we apply that 25x multiple to a very bullish 2027 earnings estimate, we get a stock price of about $267.
$267.
Yeah.
And it is trading at $551 today.
Yeah.
So that implies it is more than double what historical norms would suggest.
That's right. Second, let's look at owner earnings, a classic discounted cash flow analysis. If we assume very optimistic 25% growth for 5 years and a 10% discount rate, we get a value of roughly $320.
Still way below the current price. It's not even close. Not close. And finally, let's look at analyst consensus. Even the Wall Street bulls, the analysts at the big banks who are, incentivized to be optimistic, have an average price target around $480.
So even the cheerleaders on Wall Street are saying, hey, this might be a bit overextended.
Exactly. The verdict from a pure valuation standpoint is crystal clear. The stock is priced for absolute perfection. Any stumble, any slowdown in AI spending, any new competitor, and there's a long, long way down.
Okay, so the valuation is precarious. But what triggers the fall? Pillar 5. Risks and the premortem. If we wake up in 2027 and the stock has been cut in half, what was the most likely thing that went wrong?
We identified 2 specific kill criteria. These are the things that would fundamentally break the bull thesis.
Okay, what's number 1?
The first is the technology shift we discussed, the successful deployment of co-packaged optics by Nvidia or Broadcom in their next generation of chips.
So if the next Blackwell or Rubin chip from Nvidia has optics built in, Lumentum's pluggables are dead on arrival.
Precisely. That is a binary risk. Either it happens or it doesn't. But the second risk is cyclical and, in my view, almost guaranteed to happen at some point. The inventory correction.
The double ordering effect.
Yeah.
Explain this for people who don't follow supply chains.
Okay, imagine you are a procurement manager at Microsoft. Your boss comes to you and says, we cannot run out of transceivers. If our AI servers go down, we lose millions of dollars an hour.
The pressure is immense.
Immense. So there's a shortage. You need 10,000 units. You call Lumentum and place an order, but you're scared they won't be able to deliver on time. So you also call their competitor, Coherent, and you order another 10,000 units. You only need 10,000 total.
You're hoarding, like people did with toilet paper in 2020.
It's the exact same human behavior.
Yeah.
Now multiply that across every hyperscaler. Lumentum sees these massive orders pouring in and thinks demand is skyrocketing, so they build more factories.
Oh.
But then, in 2027, the shortage eases. The new factories come online. Microsoft gets their delivery from Lumentum. They look at their warehouse, realize they have way too many, and they call Coherent and cancel all future orders.
And Lumentum's revenue falls off a cliff.
We call it an air pocket. Revenue can drop 40% in a single quarter. We saw this happen to them in 2023. It happens in every single optical cycle. The market is currently pricing in 0 probability of an inventory correction, which is, frankly, historically naive.
That is a terrifying prospect for a stock trading at these multiples, but let's zoom out, way out. Pillar 6, the long horizon. We're talking 2031 to 2036. What does this company look like in a decade?
This is where we have to return to physics. The strategic fork in the road, CPO versus pluggable.
We touched on this, but why does physics dictate a change? Why can't we just keep making faster and faster pluggables forever?
Heat and signal loss. It's all about power consumption. As data speeds hit 3.2 terabits and then 6.4 terabits, moving data over copper traces, even for just a few inches from the switch chip to the front panel where the pluggable sits, becomes incredibly inefficient.
Why?
The electrical resistance creates heat. To push the signal through, you have to pump in more and more power, which creates more and more heat.
And heat is the enemy of density. You can't cool these data center racks fast enough.
Exactly. At some point, physics dictates that the optics must move inside the chip package to shorten the distance the electrons have to travel before they become photons. It's all about saving power.
So it's inevitable. It's not a matter of if, but when.
Most experts in the field believe the status quo holds for 2026 to maybe 2028. Lumentum will dominate pluggables in that period, but the disruption starts in 2029 and beyond.
So what does Lumentum do? Do they just die?
Not necessarily. There is a pivot opportunity, but they have to be smart. Lumentum must transition from being a module maker, making the whole box, to becoming a laser light source provider.
What does that mean in simple terms?
Even if the optics are on the Nvidia chip, they still need a light source. They still need a laser. You can't print a high-quality laser on silicon easily because, as we said, silicon doesn't emit light well.
Right.
So you need an external laser source, effectively a light battery, to power the optics on the chip.
So Lumentum stops selling the car and starts selling the high-octane gasoline.
Or the battery.
Yes.
It means lower revenue per unit because they aren't selling the whole module with all the electronics, but it could mean potentially ultra-high margins because it is pure IP and material science.
So they become a component licensor or a premium supplier to the big guys.
Yes. They would try to become the Intel of photonics. That is scenario A. That's the bull case.
What's the probability you'd assign to that?
It's tough, but maybe 20%. If they pull this off and they become the industry standard for external laser sources, the stock could hit $1,200 or more. They become a royalty stream on every AI chip sold in the world.
Okay, that's the dream. What's scenario B? The more likely one.
The commoditized utility. This is the base case. Maybe 50% probability. Pluggables survive longer than we think, but margins compress hard. Asian competitors, companies like LITE, they figure out the manufacturing, they flood the market.
And Lumentum.
Lumentum becomes a volume leader, but loses all its pricing power. Margins drop back to 15%.
And the stock in that scenario?
Dead money. It trades between $450 and $600 for 5 years. Becomes a dividend stock, not a growth stock.
And finally, a scenario C, the nightmare.
The Kodak moment. I'd give this a 30% probability. Silicon photonics advances to the point where chip makers can print lasers or viable alternatives directly on silicon, or they use new materials like quantum dots that bypass Lumentum's indium phosphide advantage entirely.
So they get completely leapfrogged.
Completely. Lumentum is left serving the legacy telecom markets, which are declining. In that world, the stock crashes to under $200.
Wow. Yes. That is the risk of technology investing. The moat is deep today, but it is very narrow.
That's right.
That brings us to the capital allocation evolution. If they see the growth slowing, they have to change how they treat shareholders, right?
Exactly. If the valuation compresses to less than 20x PE in, say, 2029, management must switch to cannibal mode. They must use their cash to aggressively buy back shares.
And dividends.
We'd likely see a dividend policy start around 2030. They would have to transition from a hypergrowth story to a quality compounder.
So we've covered the business, the financials, the valuation, the risks, and the future. It's time for the verdict. How do we score Lumentum on our framework?
Quality score. I'm giving it a medium. They have strong process power today, but the obsolescence risk, the kill criteria we talked about, is just too high to rate it as high quality.
And valuation?
Valuation score. Expensive. It is priced for perfection in a very imperfect cyclical world.
Okay, time for the red team challenge. I'm going to play devil's advocate. Why shouldn't I just buy and hold this for the AI revolution? Everyone says don't bet against AI. This is a key supplier.
And here is the cold water. You are not buying AI. You are buying a cyclical hardware component supplier at a software multiple. You are paying $550 for a cash flow stream that is very likely to peak in the next 18 months due to inventory cycles.
And when the cycle turns?
When the cycle turns, this stock won't just drift down, it will re-rate violently.
Right.
It could easily trade at $150. That's just 15 times a normalized through-cycle $10 of EPS.
Ouch. So what's the final decision?
Sell or take profit.
Plain and simple. If you have profits from this amazing run, ring the register.
The Lollapalooza has played out. We are in the reflexivity danger zone now. The easy money has been made.
Where would you be a buyer? Because
Right.
at the right price, this is a great company with great technology.
The buy zone for us is between $280 and $310. We need a roughly 45% correction to offer any margin of safety.
And why that price?
At that price, you are getting the Intel of photonics optionality for free. At $550, you're paying for it as if it's already guaranteed.
That is a very disciplined take.
It's the only way to survive in hardware investing. You have to buy when everyone hates it and sell when everyone loves it. And right now, everyone loves Lumentum.
So what does this all mean for the listener? What's the final thought you want to leave them with?
The market is pricing in that bull case,
Yeah.
the Intel of photonics scenario, with near certainty. If you hold this stock for the next decade, you are essentially making a bet.
A bet on what?
You are betting that Lumentum can cannibalize its own business model, kill its own profitable pluggable business before its customers, Nvidia and Broadcom, do it for them.
That is a tough bet to make.
It is. It's betting on the underdog against the empire. And sometimes the underdog wins, but the odds are not in your favor.
Well, there you have it, a deep dive into the light speed world of Lumentum. Whether you think they are the future of AI or a bubble waiting to burst, one thing is for sure. It's going to be a fascinating ride.
Absolutely, no question.
Thanks for tuning in to Synaptic Investing. Don't forget to check that link in the description for Interactive Brokers, and we'll see you in the next deep dive.
Stay rational, everyone.
Bye for now.